Welcome to the Euromir Roundtable. Today is the 4th of September, 2019. So welcome everyone. Today, Tim Pierson is our presenter. So Tim is well known in the Euromir community. He's the beginner and small account trading group leader. He runs a couple of trade alert services and participates in Trading Group 1 every week and hosts it sometimes when I can't make it. So big thanks to you, Tim, for all that you do. And I know you presented a little bit of this on Tuesday, so everyone's looking forward to it. So, thanks again for going into more details today.
Okay, sure. Well, um, I'll go. So you can see the Aramir slide. So yeah, we have to do the disclosure. So here we go. So Aramir is not a broker dealer securities investment advisor. I'm also not a broker dealer securities investment advisor. So there are no trade recommendations in this session. Everything you see in here is for educational purposes only. Options involve risks are not suitable for all investors, and you always trade at your own risk. And past performance is not indicative of future results, and you can read the rest of the fine print in the recording. How was that?
It sounds good, yeah.
Yeah. Okay, let's see. Let me get another slide ready here. Okay, here we go.
Well, while you're doing that, just a little background on this. We started looking at risk reversals, I guess last summer when Scott Rubel was presenting a few roundtables with us, and it's become popular. Dan Harvey started using them too in the road trip trade, and Gary built it into the G tool, and it's become a nice thing to have in our toolkit. But Tim, you took it to an interesting path by comparing is the risk reversal versus the put debit spread what you want to use when you want to defend yourself to the downside.
Right. I've been thinking about doing this analysis for a while, and I finally did it. And well, you can see the conclusion here, the results in a minute. But the G tool does an excellent job, as usual, of finding and ranking RRs, both bearish and bullish sides. Prior to that, and even now, put debit spread is one of the go-to ways that we use to both hedge to the downside in the road trips and get, in some cases, get some negative delta and make a plateau in the graph, which is what I've got on my current road trips. So they're both good tools that we can still use. But I wanted to find out a little bit about is one better than the other for what you're trying to do, and is how should you decide between doing a risk reversal versus a simple put debit spread? So that's what I'm trying to show here. So here is the first slide on this subject. I made this slide a few days ago, but it still applies, and we'll look at one that is made this morning. So on August 29th, the risk reversal ranking in the G tool had this risk reversal to get negative 8.2 delta. Okay, and then there's some of the other metrics that it measures, and these are really useful. I'm really glad that that's in there. But it was basically doing a 29.95/3010 call credit spread and a 29.05/28.95 put debit spread for 10 cents debit. And one of the things I think that we like about risk reversals is you can do it for 10 cents debit or a small credit or something, and you get all this delta. And everybody thinks that that's better than doing a simple put debit spread where you might pay $3 or $4 for it times 3 to get the same delta. So this one would actually cost $1,000. So I've long said that I'm not sure that makes too much difference, and one of the things you might see in the next two slides is why. So here are two hedges, if you want to call it hedges, that could be done on this day under these this price point, and they both have approximately the same delta. This is negative 9.6, and this one was negative 8. But when I actually did it, it was a little bit different than the time this G-tool ran, so it was about -9. So the deltas were almost the same between these two different methods. So which one is better? And the answer is neither one is better. It depends on what you're trying to do and what you're looking for. So let's get into that. So both generate approximately -9 delta. The 3-lot put debit spread cost $3.25 on that day, which is $975 in buying power plus commissions. Now, buying power and margin are two different things. However, they act the same way in your account. And I'm talking about a Reg T account here. If you buy something like a put debit spread or a long call or a long put, you can't lose, at least on the long call, you can't lose more than you paid for it. On a long put, you can't lose more than you paid for it. So they don't hit you with margin on that, but they do hit you with what it costs to buy it in your account. And so if you look in Thinkorswim, you'll see that margin is 0, but if you also look to see it was $975 in buying power came out of the net liquidity value of your account. Keep that in mind for a minute. Going on, the put debit spread typically will have positive Vega and some positive Theta. And I think that's important because if we're using this as a hedge, which this is a bearish one we're using as a hedge in this example, positive Vega helps you as the market drops. It's more favorable to the position. Okay, let's look at the risk reversal. It costs $1,500 in margin. Now this has shorts as well as longs, and for that reason, basically, they're going to take margin out of your account, but not necessarily buying power. When I did this in Thinkorswim, it was $1,500 in margin. So these two things, buying power and margin, are approximately, they're both an equivalent measure, in my opinion, of how much less other stuff you can do in your account for the value of your account. And the risk reversal in this case costs just a little bit more than the put debit spread did. Risk reversal includes a call credit spread component. So now there's risk on the upside compounded by the put debit spread component. In other words, the put debit spread will lose money to the upside, and the call credit spread will also lose money to the upside. Whereas with the simple put debit spread, it's the only component that will lose money to the upside. So how do those two compare? And that's what I'm going to show on the next slide. Anyway, here, this I think turned out to be very important. I didn't realize this till I did it, but the risk reversal has negative Vega, which means as the market drops and volatility rises, it's not going to hedge as efficiently or as well as something with positive Vega will. I think that's a very important thing to realize when you're doing this. There is a difference. But it has 3 times the Theta of the put debit spread, mostly because of the call credit spread that's up on the top. So just trade-offs, you know. So the next slide, I built this little table to show the P&L for both of them, both in a favorable move and an unfavorable move. Let's take a look.
Oh, and Andrew asked what were the strikes for the put debit spread and at the money.
Okay, so SPX was at 29.27 when I did this, and I'm choosing a put debit spread that's just out of the money, 29.20/29.10. Okay, and the put debit spread of the risk reversal was actually a little bit lower. That came into play through the ranking, but close. So it's out of the money just a little bit further. Okay. So let's talk about a favorable move. If there is no movement in the first day, if there's a 7-point down move in the first day because it was at 29.27, you've got the risk reversal trailing the put debit spread by $20. That's pretty much an insignificant difference. And you can see I took another 10 points and another 10 points. So this would be a 27-point down move. the put debit spread outperforms the risk reversal in this case. And if you look at T plus 10 days in the future, if the move happens in 10 days instead of in 1 day, the numbers are different, but similar. The put debit spread outperforms the risk reversal in all cases by what's getting to be a significant amount. Now remember, these are 1 lots, and typically, you might have a 2 or 3 lot risk reversal, which would be equivalent to a 6 or 9 lot put debit spread in this example, and the numbers would be 2 or 3 times higher. So there's the favorable move. In the unfavorable move, same thing. I went up about 10 points, 20 points, and 30 points, and I did it for T plus 0 and T plus 10. Now, the risk reversal outperforms a bit, especially in the T plus 10, and I would assume this is the effect of the higher theta that the risk reversal has. I mean, I didn't go so far as to prove that, but I would assume this is from the theta. For something in T plus 0, they're almost identical, but it outperforms a little bit. Now, because of the call credit spread, I should have probably gone 40, 50, and 60 points unfavorable move, because the call credit spread at some point is going to overpower the benefit of the risk reversal, I would imagine. That would be another step to do in this analysis. But there you have it. Basically, the put debit spread outperforms in a favorable move, and the risk reversal outperforms or underperforms the loss, I guess, in an unfavorable move, at least within reasonable limits. That's my analysis. I thought it was very interesting because this isn't actually what I expected. I actually expected the risk reversal would be as good or better. So, questions on that?
No questions yet.
Nothing new. Okay, so let me go to Thinkorswim for just a minute because I worked one up as of today, and I want to point out a couple more things. So here's today, and these top 2 are the risk reversal I took out of the G tool this morning, or something that's about 30 days out. Okay, and you can see that it's 470 and 450. So this one actually right now, when I did this, I've locked the prices, but when I did this, was 20 cents credit, net 20 cents credit. And I had about negative 10 or 10.5 delta. The comparable put debit spread that's just out of the money I chose was this one. It takes 3 lots to get the same delta. This has a buying power effect of 1350, okay, $1,365. And if I check these 2, we'll just read up in here that the risk reversal, again, has a higher margin requirement, $2,500. So there's a difference there. If you're really tight on your margin, you might not be able to do a risk reversal. Same thing is true. It has negative Vega. This has more negative Vega than my other example did. This would make a difference in a downturn. But let's look at the graph for just a minute. Here's the risk reversal. The most it can make is $1,520 if we go far to the downside. And right now it's a pretty linear curve, but this T plus 0 will change as time goes by. But if we went up, say, 50 points, that would be about here. It's down $570. If we go up 75 points, it's down $883 at T plus 0, T plus 1. Okay. Let's switch over to the simple put debit spread. Going up 75 points, it's down $703, and this is true to my table. The risk reversal underperforms, or I guess outperforms the loss in a big up move. But to the downside, the put debit spread can make double the profit at expiration of the risk reversal. So and it has positive Vega. So what I'm pointing out is it's a trade-off. If you plan to put on one of these and use it to hedge, say, for the next 10 days because something big is going to happen or worried, Which one should you do? In that case, I suggest the put debit spread might be a better choice because it'll outperform on the downside, and in 10 days, it'll be about equivalent to what the risk reversals lose, and it does not have this huge risk on the upside from the call credit spread. But if you're going to put this on and expect to keep it on throughout the life of your trade, which would be till expiration, and or do all this other maneuvering that typically Scott might do in his risk reversals, which is spread off some of this risk and turn it into some kind of condor with very low risk on either side, then you could do that to the put debit spread, but the risk reversal, I think, might be a better choice there because it gives you more choices, more possibilities of doing it. That could be debatable, but I think if you're going to hold it for a long time or to expiration and plan to do that, risk reversal might actually be a bit better choice, as long as you know that it's not hedging you as much as the put debit spread would. Okay.
So Tim, how did you make those equivalent? Did you do it based on the initial cost or the margin requirement, or what'd you use?
Delta. I'm looking for two of them that have approximately the same delta, because if you're doing these as a hedge, that's pretty much what you're looking for is delta, you know.
Right.
So -10 there, and the put debit spread about -10 as well. But I adjusted the lot size so it would get up to -10. Did a one lot put debit spread, you know, it's not the same. You can't compare them.
Another way to look at it would be to use the same max defined risk on the trade too and compare those.
You would, yeah. Um, did that. This would have to get up to about 2,500, which means it'd have to be more like
More like that, yep.
maybe a 6 lot. Nah, but we call it 5. Well, that would be more direct comparison. Now, if we go up 75 points, we're down quite a bit more than the risk reversal. If we go down 40 or 50 points, I bet this is quite a bit higher. And its maximum profit is about 3 times the size of a risk reversal.
Yeah, the profit kicks in quicker, but if you
Right.
have a reversal, you're in trouble faster.
Yeah, basically. That's what it comes down to. Yeah. Um, so I think for me, the biggest takeaway here was all that stuff, but it's the Vega. I and actually haven't looked at the Vega difference between the two of them, and positive Vega will help on the downside, which is why you're putting it on a bearish risk reversal or put it demonstrate. Negative Vega, like the risk reversal, will actually not help you as much or hurt as vol rises. Want to keep that in mind. That's just another reason why, if you're doing risk reversals, you might plan to hold them to expiration or spread them off. So I hope that makes sense. That's as far as I went. It should be done for different time periods and different T, like T plus 20, T plus 30. It should be done for a little more out of the money versus at the money for the put debit spread. There's all these other factors that'll change things, but I suspect it'll come out somewhat similar in most cases.
Well, and then volatility will also be a factor on how much you lose too if it reverses against you.
Right. Oh, exactly. Yeah, that's right.
Another way I like to adjust trades is just buying or selling some ETFs, like some spiders, just to rotate the risk graph. So you need like you're doing 7 or 9 deltas, and you do 70, you short 70 or 90 spies, and you're just getting pure delta with no other Greeks.
That's true. That's correct. But what does it cost to short, let's say 70?
70 spiders.
Yeah, let's look at that. That would be interesting. Okay, so we're gonna simply short the spider. Well, here'd be 100 of them. Much more margin, much higher margin. This would be about -10 delta in the SPX, so this would be comparable, I guess you could say. Much higher margin. But you're right. There's no Vega, there's no Theta, there's no nothing. It's straight Delta, and that could be beneficial as well.
And something like that, the benefits of doing that in a fast market, or it gets filled immediately, and you take all the pressure off of your adjustments, and you're kind of you're going from panic mode to relax. Now you can think clearly and decide what you want to do. Then put your option trades on, and then take off the SPY immediately. So it's to me, it's a way to just kind of neutralize the trade temporarily too.
Yeah, right. You could do the same thing with ES or MES
Right.
futures. I think the margin is going to be different there too. Let's see.
Should be less.
You think so? Yeah. Okay. Let's sell one. Yeah, it's a bit less, but more than the put debit spread or the risk reversal. All right, and an MES would be 1/10 of that, but you'd have to do more of them. So I've actually traded MES for that reason on after hours already once, and it worked out well. There's liquidity, it flowed right away, good pricing, everything was great. So I think MES can be.
So one ES contract would be remember it's $50 a point, so you're getting minus 50 delta. So if you wanted to
here, yeah.
So if you wanted to do like 10 delta, I think we were talking, you need two MES contracts.
Two MES, yeah. So here's MES. Let's sell two of these. Yeah, that's not bad. I mean, that's comparable to the risk reversal.
Yeah.
Margin wise. And then of course the graph is, there's no Greeks, and so the graph is like this. And this is $5 a point. The two of these is 10, so a 20-point move would be $200 in your favor.
And the good and bad thing about those is they're not limited on trading hours to the normal hours. So if something's going on after hours, you can take advantage of it, but you can also get in trouble with it. So
right. So for example, if you short some of these after hours because you're worried about a big further drop than it already had done, and then it reverses, and so you take them off and it's still after hours, then it has done nothing against your positions.
or if it's like election night and it's down 50 already, you short some of these, it gets down to 100 and then bounces and closes unchanged. Well, you sold it at 50 down, so you're in big trouble.
Yeah.
So you'd have to put stops on it.
Yeah, you have to be quick on the futures to get in and out, in my opinion. Right. Okay, well, no questions. There's a related subject I thought I'd go into. I have this slide deck with a whole list of random subjects that I've talked about over the years, but I'm going to put debit spread. So often the question is, if you're going to do a put debit spread, do you do in the money? Do you at the money? Do you out of the money? What do you do? And so I did this little analysis. This was a while back, and I should probably update it. So this was in 2017, SPX at 24.27. So I worked up three of them, in the money, at the money, out of the money. The at the money is important. This straddles the money, as I call it. So the long is above the money and the short is below the money. And I wrote down for each of these what they cost, what the maximum profit they can make, which is the width of the spread minus the cost, what percent of the maximum profit, let's see, did we pay for the spread itself. Here's the delta you get from the spread and the theta effect and Vega effect. And then I just looked at a profit and the 20-point move in your favor. So these three compare, and if you think about how a spread works, I mean, the in the money doesn't make much sense because you're paying so much for it, $16. It can only make $4, okay? And you're paying $1,600 for this spread. It'll make it faster to the downside than the other two will, but I'm going to look at that in just a second, my next slide. But has more negative Vega. And the out of the money is the one that has positive Vega. And this is out of the money by 40 points in this case. So which one to choose? Well, for years I've always said, because of all these factors here, the one that seems to be the best trade-off or the best value is at the money, where you straddle the money with your strikes. But you have to remember, we're selling the 24.20 here when the market is 24.27. Would you rather sell a 24.20? Or would you rather sell a 24.30, which means this would be 24.50 and 24.30? And think about extrinsic value. You know, the ones that are at the money have the highest extrinsic value, which we like to sell. That's one of the golden rules that you should have burned into your memory. Maybe the 24.50/24.30 would outperform the 24.40/24.20. Now, I've looked at this, and it does. It's a small effect when they're this close, but now you're paying more of the maximum profit for the spread, maybe 40–50%, and so there's a trade-off there. So for that reason, I like to be close, but I favor 1 or 2 strikes out of the money when I do this. So in all my PDS adjusting these days, I'm out of the money by not as far as this is, but I'll be 1 or 2 strikes out of the money, which means the long might be at 24.10 right now, or in this example, with a short at 2400 or something. Well, it's hard to see in this graph, but the T+0 line kind of tells you why these are different, partly. Again, you're doing this because you want to hedge to the downside. That's the whole reason for putting this thing on. And it's hard to tell in this graph, but what you want to look at is the slope of the T+0 line at the current price. That'll give you an indication of how quick this is going to kick in if it moves in your favor. Because notice the line flattens out the further we get in the money. And if you can imagine the slope of this line as being, 40 degrees or something, now we have an at the money, and the slope of this line is a little bit less. You have to do the math and see it in the numbers, but the slope is a little bit less. And then the out of the money one, slope is a little bit less, which means the out of the money one won't kick in so much as fast as the in the money one will, but it costs a whole lot less and has a much higher profit potential. So every time I look at an analysis like this, there's always trade-offs, but this kind of explains one of the differences between these three.
Probably one column you could add is how much do you lose if it goes 20 points against you?
Yeah, I should. I need to redo this and add that in. That would make sense.
Right. I think you see that you're for the out of the money, you're not paying as much. So if it moves against you, you're not going to lose as much.
Right. That is true. Yep. Right. So and then in the money has the highest negative Vega, which isn't going to help as much during a volatility rise and a downturn. So that is something to keep in mind. Okay, well, those are my put debit spread slides. We have a question.
Let's see. Jed Clampett says, as I like to say, run to the shorts. And John Bailey says, Tim, for me, it's about how confident I am in my directional bias. If very confident, then I'd choose out of the money. If not so confident, then be happier with at the money.
Yeah. That makes some sense. I can agree with that. But no matter which one you do, I think depending on how confident you are, you want to be quick to take them off before they lose very much. I think that's as important thing to think about there. If you're not very confident, put on a small one maybe, put on one more near the money. That'll help in a downturn, but be quicker to take it off.
I guess if you're going to do more research on this, it'd be nice to make matrices of different types of out of the money and spreads just to compare, the trade-offs that you have.
Yeah, I should.
But that's always like any kind of trade you're trying to hedge the downside, you're trying to balance how much delta do I need, how much Vega, Theta, all that. Is it going to cost me my max risk to the upside if it goes against me? Just different ways to hedge against a bigger downward movement.
Right, right. I'll try to remember that. Yeah.
Oh, let's see. John also added, you could also look at vertical skew and see if there's an upward kink at a strike that could be worth selling at your short strike. It's a good point.
Good point. Yeah. There's lots of variables involved with all of this stuff, and that's I guess where skill and education comes into play. You need to have some kind of an understanding of how all the variables work.
A lot of moving parts.
Okay, I got another one if we have time. I think we have a few minutes. Let's see. Is it this one? Yeah, but I'm going to start with this one. Okay. Again, I did this a while back, but I wanted to compare road trip with normal entry, which might be what this looks like, versus putting the butterfly really far out of the money to the downside. Because I met somebody who thought putting the butterfly and the shorts down 100 points or more was a much safer trade. And so I wanted to see if that was the case and do this analysis. And again, it comes down to trade-offs. It always does. And I didn't write notes on this, but here's a normal road trip, and we might start with the shorts this far out of the money, maybe, and this is what the graph might look like. I used to, and I still do, always look at what is the P&L at the T+0 down 100 points from entry. Okay, that's one of my metrics. And it's just simply a different way of looking at it than some other metrics that are already in the G tool, but it's a quick visual way to do it. So down 100 points, the P&L is minus $1,545. And what I always wanted was for that to be not more than about 3/4 of the way to max loss, which is $2,000 on 10 lot for me. Okay. So this fits all that criteria, and this is a normal entry. And before, the other thing to look at is if you did a reverse Harvey, at least at the current prices, what would its credit be? 245 would be its credit in this case. You might be doing a hybrid entry. That's when you would do one of these right off the bat, or later when you do reverse Harvey, things will be different. But anyway, you get the idea. Now let's go over to my other slide. This is a very far out of the money road trip. I believe I did this on the same day. And so if you look at 100 points out of the money now, which is this one here, we're down 685. And so you might say, well, that's a whole lot safer, because half the loss at a 100-point move. And I know this doesn't take into account volatility. But look at the reverse Harvey now. It's so much further out of the money that the credit is so much lower, and that'll make a big difference. So you don't have the same ability to reverse Harvey the trade if the market goes up as you do in a normal road trip. And I think this is one of the reasons why normal turned out to be the way it is as far as how far out of the money the shorts are. Now, that doesn't mean everything in the world, because you can just do higher strikes, which is a put credit spread, and put your put credit spread up here somewhere and get more credit. But now you have a dip in the graph that's outside of the tent, which can be a factor late in the trade, depending on how you do it and how long you stay in it. Our normal reverse Harveys make a dip in the graph that's also inside the tent, so you don't see it very much, and that also means it doesn't affect you very much, especially if you stay late in the trade, because the dip is actually just a slight dip in the tent here, instead of actually going below zero like it would in the extreme example. There's other factors as well. You have to watch your delta. Your theta is not going to be as good. You have 23 versus 16. You know, that's not too big in the beginning, but the longer you stay in a trade, the harder it'll get to manage this trade and keep your delta under control. So it's a good thought to go really far out of the money, and in some cases it can benefit you. For example, if you can actually get a credit for this and be this far out of the tent to the upside and the market stays there or goes up, that can be a real good feeling trade to be in. But you know, in all cases, I'm not sure this is necessarily better. So I did a little comparison of this. Lower trigger point. Trigger point is the trigger at which you would do a put debit spread or some kind of a downside adjustment. Lower loss 100 points down, we saw that, but lower theta, but the one that kills it for me is greatly reduced ability to manage the top expiration by reverse Harvey.
It's like Joe Ross used to say, he wants to get paid to trade.
Yeah, that's about it. That I think is probably why we're doing this, right? So that's my little analysis on that. I know it could go further and I could explain it better, but I think the thing to keep in mind is it's a trade-off. If you go 100, or I even knew this person tried 200 points out of the money and had losers every time, and it's like, you know, why is that? And this is all partially why that's the case.
Yeah, my brother always liked to super exaggerate things to illustrate things better. And in this case, you could say, well, what if we make it 1,000 points below the money?
Yep.
Well, you'll be really, really safe, but you won't make any money. So.
Right. Right. And yeah, so the delta is going to get out of hand on this very far out of the money one up in here somewhere. In other words, the buffer between the current price and wherever it is that you want to do your first put price spread or reverse Harvey, that distance is approximately the same for both of them. I know you can't see it in the graph, but it's approximately the same. Well, I'd like to get more, if I'm going to have to do the same thing at the same point move, I'd like to get more credit for it, and I'd like to not hurt my graph, you know, and the normal road trip works out better in both of those respects. So I hope that was interesting to people.
Yeah.
And let's see, I'll go another step here. Where's this? Here. This is information that we should all have in our head, an instant recall and instinctive recall. And so this is basic knowledge. This is just review, but what happens when you buy a call, buy or sell a call, and buy or sell a put? And I guess I shouldn't say what happens. I should say what happens and or what will happen to you. Because in the case of the shorts, it's not your decision that you're going to have to sell the underlying at the strike price or buy the underlying at the strike price. Somebody else's decision. When you have longs, it's pretty much your decision.
Yeah, and the easy way is buyers have rights and sellers have obligations.
There you go. That's great. Yeah. Yep. So this is, you know, every once in a while, I think it's useful to do a quick review of basic knowledge that you have or don't have, and just review things like this so that you can keep it in mind in your trading. You know, it's the same thing with extrinsic value. You'd like to sell it instead of buy it. I have another slide about that. Where is it? Extrinsic. Not there. Okay. This is a slide deck with over 50 slides in it, so I'm just kind of going through a few different things. Boy, where it go? Ooh, is it not here? Basic knowledge. I can't find it right now. God, I hope I didn't lose it. but it's what I call golden rules of option trading, and one of them is sell extrinsic value and buy intrinsic value. Where that slide went, I don't want to lose it.
Well, it's probably there somewhere.
Yeah. Okay. Here's another, I don't know if you want to call it basic knowledge or whatever, but everybody gets worried about their commission. So I got looking at it and I said, well, which is better? You know, if you have a broker with a ticket charge and 65 cents a contract, or you have another broker that we have a $1.25 flat contract rate per options contract. It's fairly simple mathematics. I set up the linear equation and solve for x, and I find x equals 10. What that means is if you're trading less than 10 lots, and so like say you're doing a 3-lot put debit spread, that's 6 options contracts in one trade, right? The $1.25 flat rate is going to be cheaper overall commission than the one for with a ticket charge. But if you're trading more than 10, like you're putting on a butterfly and it's a 50, it's a 40-lot trade because you're putting on a 10-lot butterfly, then the $6 ticket charge and 65 cents a contract is quite a bit cheaper. So what that means is, in this example, it'd be a lot cheaper to open and close trades if you can do them by butterflies, but making small adjustments will be more expensive commission-wise. I'm not sure what to make of that. I think what it turns out to be is, what is your average lot size when you're making adjustments? And if that is ending up being around 10 on average, then they're about equal. If it's over 10, then the ticket charge is cheaper. How do I implement that? Well, I do trade with a couple of different brokers, and I have a situation similar to this between those two brokers. And so I take the big trades, the really big ones, and give them to the one with the ticket charge because it's a whole lot cheaper for me, both adjusting and putting them on. And for the ones that are smaller, then I take the one with the flat contract rate. It doesn't matter to me what broker I go to, so I might as well go to the one that's going to be less commission, right?
As long as you're getting the same execution.
Yes, execution is very important. Now both of mine have pretty darn good execution. In fact, the one with the ticket charge often gets better execution than the one without. But if the numbers are different, where does this turn out to be? So if you have a $1 flat rate versus a $5 ticket charge and 65 cents, you do all the math, and it's a higher contract thing. So you need to take your commission rate and do the one that applies to what you're doing.
And Tim, I saw the Silex icon on your desktop, I think.
Yeah.
Do you know offhand if they work with Tradier?
I don't know.
Because I know Tradier has that flat rate. So if you can find a broker that has a flat rate, then and you trade a lot, then it may be better to find something like Tradier or the Silex that could run orders through it and still manage your risk graphs and stuff.
Yep.
I wrote them, but they haven't heard back from them.
Silex or Silex is what we use when I traded on the trading desk. And I should take that off because I don't use it anymore. So they had a pretty good commission rate, and their execution was pretty good. So I think they're all good there. They just went through some back-end broker. I don't know who it was.
Right. Just curious if you knew off the top of your head.
Yeah, no, don't know. Okay. Do we have any questions, comments?
No, I think that's about it. So
Somebody let me know if this kind of analysis is good or useful. I hope so.
and this is the kind of stuff you talk about in the beginner and small account trading group.
Right, and even sometimes in my mentoring.
So if people have questions or want to take it further, then those are good places to catch up with you, or also the forums, of course.
Yeah. Here's another one. There's a lot of road trip traders here. I run service now, so I can do all this. But don't look at this as a frown. I guess you could, but that's not what I meant it to be. But if you think about during your road trip trade, how much margin should be deployed to be optimal, I guess you might say. In my opinion, it turns out like this. So when you put the trade on, you should use something less than 100% of the margin that you're willing to use for that trade. Now, I do trade with a $3,000 per lot limit. I don't go over that in my margin. If you don't care about margin, then this doesn't apply, I guess. But I like to start with less than my total margin and let it grow up until about mid-trade. And then in an ideal world, I'd be peeling off or making adjustments that reduce margin towards the end, which is taking risk off the table. And this would be an ideal curve. What happens in most of my trading is it probably looks something like this. And then from here, it pretty much probably goes straight out because I keep it limited. But if you did this, you'd be taking risk off the table and freeing up margin for your next trade. So it's an ideal goal.
Well, great. Well, I think it's probably a good time to wrap it up, Tim.
Oh, okay. Well, that was fun to do a number of things there.
Yeah,
Um,
definitely.
I just
So thanks for sharing your slides and research with us.
okay. Then well, we'll see all you guys next time.
Yep. And again, we're hanging out in Trading Group 1. And Tim, you're going to be hosting next week's Trading Group 1 because I'm going to be at the airport waiting to
Right.
get on an airplane. So,
Right. Okay.
so thanks, everyone. We will catch you all next time. Thanks, Tim, and we will see you later.
Okay. Bye.
Bye.